I think that Liberation Day stands as one of the great policy errors of all time. All of these aspects of the safe haven status have been thrown into question over the last few months. And interestingly, given Trump's drill baby drill mantra, we're now at around the strike price where you start shutting wells in America and new projects become unviable. My concern is that Europe still has huge structural. One of the questions is who's calling the shots here now? Who's actually driving policy?
I'm going to do something terrible to you. I'm going to chuck back a quote that I gleaned, or David and I both gleaned from your website. The market seems persuaded that we are past the peak of Trump's tariff lunacy, but the path back down Mount Stupid will be long and bumpy, and some of the damage inflicted in the last few weeks will be permanent. Now, I will obviously ask you about where you think investors should be looking right now, but those are pretty strong words. Do you still stick by those?
Yes, I do. Yes, very much so. I think. Well, yes, I think that Liberation Day stands as one of the great policy errors of all time. It was a spectacular
own goal, wasn't it?
Own goal. It seems to be quite clear that the United States came within hours of a Liz Truss moment. I mean, effectively did have a Liz Truss moment. Clearly, the market has reacted very positively to this because the expectation going into the weekend was that Trump was saying 80% would be a good landing point. Various news reports have suggested the White House was considering somewhere above 50%. So to come in at 30%, all of these aspects of the safe haven status have been thrown into question over the last few months. So I think that remains, that's part when I talk about the bumpy path down Mount Stupid, and we're not out of it yet. I think these are the sort of unanswered questions that are still out there, which is the doubts around the safe haven status of the dollar and of the US Treasury market, which the deficit is a very large part of. Yeah. And I think that is something that over the market is still having to internalize. One indicator I would point out, which I think is, a real world indicator that's flashing red, is the oil price, which down at $60 a barrel. A lot of that is due to global growth concerns, now obviously exacerbated by Saudi and OPEC production increases. But in the first instance, the oil price was a reflection of concerns about recession. And interestingly, given Trump's drill baby drill mantra, that we're now at around the strike price where you start shutting wells in America and new projects become unviable. I mean, obviously, this is now one of the biggest rallies in US stocks of all time. Yeah. It's
right to 87, aren't we? Really?
Yeah, I mean, it's a remarkable rally. But there are other things that haven't rallied. I mean, so the dollar's still lost some ground. Gold is still high. As you say, European equities are much higher. Yeah. So, and as you say, so it's quite concentrated. Yeah. And I think that's sort of quite significant. I mean, if you remember the original sell-off in the S&P started with the DeepSeek moment in January. That was actually the peak.
Absolutely.
So some of this maybe simply be the sort of investors regaining some confidence in the US tech story. But it's more broadly, so the word I keep seeing in all the research I read is diversification, and I think that's
what's your risk.
Yeah, so I think when we're talking about the bumpy path down Mount Stupid, I would say that is the thing that I think people are taking from this episode. At the start of the year, or the end of last year, it was absolutely extraordinary, the degree of concentration and the bullishness about America. And it was
illogical, wasn't it?
All the surveys of fund managers were quite extraordinary, the allocations to America. America was taking 70-80% of global capital flows into its various markets. I wrote a column for the FT published on New Year's Eve, I think it was, saying that the bearishness towards Europe was completely overdone. And I think what, when obviously you've seen a lot of that unwind.
Yeah.
So I think that if you take the concerns about the safe haven status of the US dollar and treasury assets, if you take the concerns about the capricious nature of Donald Trump's policy making, concerns about who's in charge, uncertainty about where this whole tariff process is heading, what will happen at the end of the pauses. Is Trump going to insist on a substantive trade deals, or will this be like the deals he did in Trump 1, which were just cosmetic deals, and he'll just declare victory and move on? All those questions are out there, and I think that. So I think that, to my mind, it seems fairly clear that global investors will continue to reallocate some of those extraordinary flows of funds to the US to diversify. I think has been again extraordinary. It's just the valuation gap that opened up between European equities and US equities towards the end of last year, with UK equities way behind even the Europeans. And I think that valuation gap was screaming out to be closed at some levels. So I think there's a value gap there. But also there's, if you're trying to diversify in order to hedge against American policy making, there aren't big liquid alternatives out there. And I think one of the narratives I'm very interested in this year is the European narrative, is the European piece of this, because in many ways there's an extraordinary opportunity for Europe now to capture some of these capital flows, and I think that it's although I wrote at the beginning of the year that I thought that Europe was people were much too bearish on Europe and grossly unfunded, there's a danger of the sort of euphoria of Europe getting ahead of itself, or even the Europeans themselves becoming complacent about recapturing this capital. I think Europe has huge structural issues which it needs to address, and at points in the last few months it's looked as if it may finally be willing to address them. My concern is that Europe still has huge structural issues. So Mario Draghi wrote a piece the end of last year, which I think didn't get nearly enough attention. He pointed out that the internal barriers to trade still within the single market are the equivalent of a 45% tariff on goods in Europe and a 110% tariff on services in Europe.